afternoon, and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. For our newer listeners, before I introduce today's presenter, a few quick notes. Everyone that is registered for today's program will receive a copy by the end of this week. And if you have any questions, feel free to enter them into the lower right side of your interface under the Q&A bar. Today, we have founder and managing director of Kerrigan Advisors, Erin Kerrigan. Erin is a recognized industry expert on dealership buy-sells, valuation, real estate, and private equity. And today, she's going to give us a look into 2021's buy-sell market and franchise valuation. So, Erin, take it away.
Thank you, Rachel, and thank you, AIADA, for inviting me to discuss our incredibly active buy-sell market and the drivers of today's record valuations. On this St. Patrick's Day Eve, I thought it only appropriate to employ an Irish theme to this presentation. Of course, my family is of Irish descent, and my father always told me, if you're lucky enough to be Irish, you're lucky enough. I think we would all agree that if you were lucky enough to be a part of auto retail in 2020, you were definitely lucky enough. It sure feels like our industry has been blessed with the luck of the Irish over the last 12 months since this pandemic ensued. Starting with the incredible profits achieved last year. Despite a 4% decline in revenue and 2 months when the majority of our dealerships were barely operational, the average dealer achieved record earnings in 2020. Not only record, but increased earnings year over year by almost 50% as compared to 2019, and a full $600,000 more than our prior peak in 2015. Dealers demonstrated their ability to adjust quickly. Unlike other cyclical industries, auto retailers are uniquely positioned to increase profits in a declining revenue environment. Very few businesses can achieve this. The nimble nature of our business model made it not only counter-cyclical last year and continuing to be, but nearly impervious to unforeseen economic disruptions, such as a global pandemic. As you can see here, dealers were able to quickly shift gears and increase new and used gross profit margins in reaction to a sharp decline in our highest margin business segment, fixed operations. And they demonstrated, you all on the line, demonstrated quite adeptly the price elasticity of a dealership, adjusting vehicle pricing quickly as revenue mix shifted. This move resulted in a dramatic rise in earnings, even though fixed operations was down 7%. Gross profit improvements coupled with significant reductions in variable expenses, including SG&A, floor plan, and advertising, resulted in a $688,000 improvement in the average dealership's earnings in 2020. Now, based on our discussions with dealers, we find that most are waiting for the forgiveness of the PPP loans before they bring them into income. So we believe the majority of 2020's earnings improvements that you see here do not reflect PPP funds. Not surprising, with our industry's earnings soaring, the buy-sell market, after a brief stutter in March and April, came back with a vengeance in the second half of the year, resulting in a record number of transactions. 2020 recorded 289 buy-sells, a 24% increase over 2019, with the fourth quarter reporting an all-time quarterly record of over 100 transactions. Of course, with earnings up so dramatically, valuations were also on the rise. Kerrigan Advisors estimates that the average blue sky for a dealership increased 20% by the end of 2020 as compared to 2019, the sharpest rise we have ever recorded, reflecting buyers and sellers' expectations that some of the earnings improvements achieved in 2020 are definitely sustainable in 2021. Especially when you think about expected retail sales growth this year. NADA and TrueCar estimate that retail, not fleet, just retail vehicle sales will rise 11% in 2021, supported by stimulus checks, which are hitting mailboxes as we speak, as well as incredibly low interest rates. Of course, this rise assumes inventory levels also rebound as the chip crisis mitigates, likely resulting in some declines in vehicle gross profit margins. However, most expect that decline to be offset by higher levels of sales, as well as a steady increase in high margin fixed operations as the economy reopens with the rollout of vaccines throughout the country. So, with that backdrop on the current levels of activity and direction of valuations, I thought it'd be helpful to look at the buy sell market both from the buyers and the sellers' perspective in 2021, starting with buyers, many of whom seem to be finding that elusive pot of gold at the end of the rainbow, given their incredible access to capital in 2021. Starting, of course, with our public auto retailers who have achieved record stock prices since last St. Patrick's Day. The Kerrigan index of the 7 publicly traded auto retailers surpassed the 1,000 benchmark for the first time in its history on March 5th. In fact, the index has outperformed the S&P 500 by over 200% since last year's March lows, mostly due to the fact that our industry's ability to grow earnings despite the retail challenges of COVID-19 very much sets us apart from most other businesses out there, especially in retail. What this means is that our companies not only have access to capital from their growing cash flow from operations, but also can easily access the equity markets to raise funds, which Lithia did in the fourth quarter, raising $1.2 billion in debt and equity. Now, armed with rising stock prices, most of the publics are now looking to be acquisitive in 2021. And they're following the lead of Lithia and Asbury, who completed an incredible $2.5 billion worth of acquisitions last year, adding to the many records achieved by our industry in 2020. You can see here that last year's spending surpassed the prior peak in 2015 by over $1 billion. And keep in mind, this was just 2 of our publics that did acquisitions. So this is a really incredible feat. Clearly, Wall Street is impressed by Lithia and Asbury's ability to make accretive acquisitions and their aggressive plans to add billions of dollars of revenue as they consolidate the industry. Both companies have higher market caps than their competitors despite their lower revenues. So you can see here the blue dots are the 2020 revenues for each of these public companies, and the bars are their market caps. And you can see that Lithia has a $10 billion market cap, and yet their revenue is $13 billion, while AutoNation and Penske have $20 billion in revenue, but their market caps are much lower than Lithia's. Likewise, Asbury has a market cap of $3.3 billion, but a revenue of $7.1 billion, which is much lower than Group 1 and Sonic. Now, given that market capitalizations reflect the present value of future earnings for these businesses, it is not surprising to see investors are actively rewarding Lithia and Asbury with higher valuations because they expect these companies to grow earnings faster than their competitors, given their recent acquisition performance. We expect other publics to follow Lithia and Asbury's lead in order to capture the higher blue sky multiples that both of these companies are being rewarded with by Wall Street. As you can see here, the more these companies have done acquisitions, the higher their multiples, the easier it is, of course, for them to continue to do acquisitions. So we expect to see the other publics follow suit. In addition to our existing public companies, our industry will likely see new public companies come into the fray, such as LMP Automotive, which recently acquired its first dealerships this month, and our firm represented on one of those deals. We could also expect to see new SPACs acquire dealerships, as a great deal of capital is sloshing around in these newly raised public entities. As you can see on this slide, the SPAC market, and SPAC stands for Special Purpose Acquisition Company, has grown exponentially in the last year. And our firm would not be the least bit surprised to see one or more of these SPACs make meaningful acquisitions in our consolidating $1 trillion auto retail industry. We also continue to see a rise in private equity investors seeking to commit capital to auto retail. Kerrigan Advisors' database of investors, which includes family offices, ultra high net worth individuals, and private equity firms, has increased nearly 300% since 2015 and now has over 377 distinct investors who are actively looking for ways to commit capital to dealership enterprises. In addition to the liquidity available in the public and private equity markets, the debt markets are likewise very flush, with yields at all-time lows, as you can see here on this slide, and bond issuances, even for the riskiest bonds, at all-time highs. Today's low-yield investment environment, combined with the incredible amounts of liquidity in our capital markets, is really driving up asset prices and down expected returns, forcing investors and dealership buyers to take on more risk to achieve their expected return on capital. With lower cost of capital and lower expected yields, blue sky multiples for many franchises are on the rise. More buyers are willing to accept lower returns and pay higher multiples because they view auto retail as one of the most attractive places to invest capital on a risk-adjusted basis, particularly in certain markets. Which brings me to another buyer trend we are seeing, and that is, of course, a strong bias for high population growth markets. As you can see on this slide, there is a direct correlation between population growth and buyer demand in Kerrigan Advisors' proprietary buyer database. 42% of buyers in our firm's database are seeking dealerships in the southern region of the U.S. The fact is, the pandemic exacerbated the country's migration to markets with higher standards of living and more affordable housing, resulting in a dramatic surge in population growth in certain states. Professionals are now untethered to urban office environments and very expensive housing, and are increasingly choosing to relocate their families to more economically attractive states, particularly Texas and Florida. Over 25% of the buyers in our database request Texas and/or Florida as a target market, which is not surprising when you look at the characteristics of these states. Not only are these buyers attracted to their incredible population growth, but they are also very attracted to the ease of doing business in these states and the fact that there is no state income tax in them, resulting in Texas and Florida dealerships being much more profitable investments, even at higher multiples. Kerrigan Advisors finds that dealerships in these two states in particular trade for multiples 1 to 2 times higher than our published ranges. We also find that other states with high growth aspects to them and that are business friendly, namely Arizona, Colorado, Georgia, Nevada, North and South Carolina, Tennessee, and Utah, also command higher multiples, but not quite as high as Texas and Florida. With this in mind, let's turn to the seller's perspective on today's buy-sell market. Kerrigan Advisors expects today's buyer demand will be met with an increasing supply of dealerships for sale in 2021, resulting in another record year of buy-sells. That said, we still believe the market will remain a seller's market as the demand for top franchises, particularly in high growth markets, outstrips supply. There are simply a finite number of great acquisitions and a huge and growing pool of capital seeking them. For those dealers who are choosing to sell today, many share with us that the industry is just not as much fun as it used to be, sort of like celebrating St. Patrick's Day during a time of COVID. For one thing, the drumbeat of consolidation is putting more pressure on dealers to either expand or sell. Inertia is increasingly considered a bad strategy. COVID-19 further highlighted the growing importance of scale as a determiner of success, with the largest groups achieving outside profit margins relative to smaller groups and single-point dealers. The number of dealers with 5 or fewer stores is on the decline, while those with 11 or more has increased 82% since 2010. More and more dealers share with us that they feel they need to either commit to growth or sell their business. We also are finding that more owners of large multi-dealership groups are choosing to sell rather than compete with consolidators who rely on corporate rather than personal balance sheets to finance their acquisitions. And this is an important point. As our industry continues to consolidate, it will become more difficult for family enterprises to go it alone with their personal capital. As a result, we expect more dealer families will link up with outside investors to grow their future enterprise, transitioning from their family's balance sheet to outside investors' capital. In so doing, they will hopefully stay in the business while reducing their personal risk and conversely increasing their risk appetite to complete acquisitions with other people's money, OPM. Of the dealerships currently owned by the top 150 dealership groups in this graph you see here, over 10% are now owned by groups backed by outside capital. And in many cases, a dealer is still leading, a legacy dealer is still leading those groups, but the capital involved is not their own personal balance sheet. One of the factors that is influencing some dealers' decisions to sell are the OEMs who are so jolly about the future of their electric cars, direct-to-consumer strategies, digitalization, one-price inclinations, and other new business buzz jargon words that they like to employ. All the while while they ask you with a big smile on their face to invest in more and more expensive facilities and equipment, and to just trust them. It will all work out. They've got your back. Some dealers are rightly skeptical of these OEM leprechauns, and perhaps there is evidence for them to be, as you could see by the abrupt announcement by Volvo last week, in which they let all their dealers know they're going exclusively online with one price and all electric in the very near future. More dealers are thus choosing to sell their enterprise because of the risks associated with industry disruption and the opaque path forward for the business model, which dramatically contradicts with OEM's current facility demands. Like the nearly 20% of Cadillac dealers who chose an exit rather than making the required investment in electrification, more dealers are choosing to sell their dealerships in order to avoid facility upgrades or other investments that seem to come with a rising amount of risk as the business model evolves and likely requires more scale to sustain some of these big changes. As a reminder, by the way, our industry, of course, was successful in 2020 largely due to the fact that we had pricing flexibility. If this flexibility were to be taken away, as Volvo is planning, the nimble nature of our business model would be significantly curtailed, and that would certainly be a challenge, especially for smaller dealers and dealer groups. The risks associated with facilities are particularly of concern for some luxury dealers. As you can see here, luxury rents rose 21% in 2020, while domestic stayed about the same and imports rose only slightly. Luxury OEMs seem to be moving full steam ahead with electric vehicle plans, while also requiring very expensive image facilities, even with sales heading in a digital direction, leading to a rising number of luxury dealers choosing to sell rather than double down on their single-purpose luxury facilities. In fact, in 2020, import luxury dealers saw their market share of the buy-sell market increase about 50% from 13% of the market to 20% in 2020. 13%, pardon me, in 2019 to 20% in 2020. As facility demands drove some to cash in on sky-high blue sky values rather than double down on their investment. The increased supply of import luxury franchises coming to market is being met with overwhelming buyer demand. Buyers are highly attracted to luxury franchises, even with the real estate demands, because they are witnessing the rising share of luxury sales in U.S. auto retail. Luxury consumers were minimally impacted by the economic effects of COVID-19, as their stock portfolios hit new highs seemingly every week, and many retain their income. Also, I should point out that luxury franchises typically have a higher fixed absorption rate. So while their facilities are expensive, the fixed operations does usually cover those expensive facilities. Okay, now that we have reviewed both buyer and seller's perspective on the market, let's turn to the blue sky multiples and wrap up this webinar. I've already alluded to the high valuations we are seeing in today's market, driven by rising profits and rising multiples, particularly in high growth states. Kerrigan Advisors will be publishing our full year 2020 Blue Sky Report tomorrow on St. Patrick's Day. Today, you are all getting a sneak preview of the trends we'll discuss in that report, as well as our changes to multiples for the fourth quarter. Now, most of you on the line are familiar with the drivers of blue sky multiples. As a reminder, the multiples we publish should be applied to trailing 12 months earnings, removing the one-time effects of closures and normalizing for certain profit improvements that may not be sustainable in 2021, such as one-time payments of PPP funds. I'd like to note that a trend we discuss in our Blue Sky Report is that sellers increasingly expect valuations that recognize 2020's improved profitability, as they increasingly expect profits to largely remain at these levels in 2021. To acquire dealerships in today's competitive buy-sell market, buyers will need to determine if or how they can sustain today's profit levels. Those buyers who believe they can will likely complete acquisitions this year. Those who look to prior year's profits exclusively to determine valuation will really struggle to get deals done, as sellers will simply choose to retain their businesses and reap the rewards of their current profitability rather than sell off of prior year's earnings. Now, as already discussed, we find that buyer demand is the biggest driver of blue sky multiples today, and in certain markets results in multiples as much as 1 to 2 times higher than our published ranges. So for instance, an underperforming store in a high growth market with an image facility with the right rent factor and strong fixed operations may trade as much as 2 times higher than our top multiple in our published Blue Sky report. The key here is to look at our published multiples as guideposts, recognizing that these 7 factors must be taken into account to determine value. This quarter, when assessing our blue sky multiples, we took into account how OEMs may execute on the transformation to electric and online sales and how that may determine their future franchise values. Manufacturers who are supportive of their dealer networks and value auto retailers' contributions to the OEM success will likely see their franchise values rise in the future. While OEMs who maintain an adversarial relationship with their dealer network and view their success through a zero-sum paradigm will likely see their franchise values decline. This is something we are going to keep a close eye on throughout 2021. With this in mind, Kerrigan Advisors made 2 changes to our blue sky multiples this quarter. We increased Toyota's blue sky multiple to a 6 to 7 range. And this move reflects very strong buyer demand for the franchise, in fact, the highest buyer demand of all non-luxury franchises, and an expectation that Toyota's partnership relationship with its retailers will ensure franchise value remains high even as the industry evolves to a digital electric era. We likewise increased Mazda's blue sky multiple this quarter, bringing it in line with VW. Mazda has aligned itself closely with Toyota and now employs TFS as its captive, successfully navigating 2020 and increasing sales, market share, and dealership earnings. We made no multiple downgrades this quarter to any non-luxury and luxury franchises, which of course is not surprising given the strength of our industry. Here are some of the metrics we track each quarter for each franchise. Our upcoming report includes our annual franchise review, which details these metrics quite a bit. So I strongly suggest you download it when it comes out tomorrow. I'd like to point out that we have positive outlooks on 5 franchise multiples for 2021, specifically Chevrolet, Ford, Hyundai, Kia, and Buick GMC. These positive outlooks mean that we could end up increasing these multiples in 2021, either due to rising buyer demand or strong new product rollouts that are expected to improve future sales. Turning to luxury franchises. For luxury, we made no changes to luxury blue sky multiples. Sorry, this is being very finicky here. So I'll just, you can look at our report for the exact multiples if it won't stay on that slide. Okay, stay. We made no changes to our luxury blue sky multiples this quarter, though I will share that multiples for top luxury franchises in high growth markets are often trading in the 9 times or higher range today, which is, again, very unusual, pretty incredible, and something that we have never seen in our careers. So certainly another reason we are seeing a rise in dealers selling that own luxury franchises. This is really a result of top luxury franchises having a superior business model with lower dealer counts, which drive sales per franchise higher and result in very strong and highly profitable fixed operations, making top luxury franchises really attractive investments, even in an evolving retail environment, and even given that they do have expensive facilities. In fact, we think that we will continue to see luxury franchises dominate, or not dominate, but grow in market share in the buy sell market. I do want to point out one change that we made in this quarter, which is that we did downgrade Audi's multiple outlook to negative. So we haven't downgraded the multiple, but it is on effectively a watch list. Audi dealers' profitability is more variable than its top luxury competitors, resulting in lower buyer demand in general for this franchise. This sums up our major changes this quarter. I do encourage you again to download the full report. There are pages and pages written about each of these franchises, and I think you'll find it quite interesting. In closing, I thought it only appropriate to end with this very optimistic quote from Earl Hesterberg, President and CEO of Group 1 Automotive, who said very definitively on his last earnings call, "We see several years of new vehicle industry growth ahead of us and the ability to improve our vehicle sales levels with better supply, a meaningful recovery in our service business as lockdowns end, and an ability to leverage our improved cost and debt levels as well as our financial strength." I think this positive outlook on 2021 bodes very well for all dealers, whether you are buying or selling, public or private. There is no doubt in my mind that dealers have the luck of the Irish. Happy early St. Patrick's Day to everyone, and I am happy now to answer any questions that you may have. Let's see here. I have a few questions that Rachel forwarded on to me, one of which is, do you foresee valuations increasing? And I guess what I would say there is that with the dealers that I speak with and I see their financials, 2021 is continuing to validate the improvements we saw in 2020. So as those continue to rise or sustain the high levels we saw in the second half of 2020, I do think you're going to see valuations continuing to increase throughout the year. I do not know how long that will happen, but I do think valuations will continue to rise. The next question is, how do you think growth in sales of electric vehicles in the next 5 to 10 to 20 years will affect the profitability of dealership service departments? So this is a tricky one. And you know, I've had many conference calls with some of the OEMs, and I ask them almost every time, have you modeled out what the dealership business model is going to look like as you all transition to this new model of electric vehicles? And you know, they don't have a very crisp answer to that. And so what I would say is my biggest concern for dealership profitability is the fact that you're effectively going to have to run 2 types of fixed operations. And so that inherently is going to be less efficient and more expensive. We expect that by 2030, only 10% of the UIOs in the US will be electric. So that means you'll still have your combustion engine business, but you're going to have the expense associated with this whole new service department and continue to service your legacy customers, which are inherently going to be a shrinking pool. That's where scale becomes an important factor, because I do think that scale can mitigate some of these risks. Whereas if you're a single point dealer or you have 2 to 3 dealerships, that's going to be an expensive equation to undertake as you are forced to transition to really a different business with electric vehicles. And then another question is, how have buyers assessed the impact of government financial support that may have benefited acquisition targets in 2020? So, obviously, analyzing 2020 earnings is a very challenging thing for many buyers. And I already shared with you that we're just seeing a trend that sellers feel quite confident in the sustainability, especially of the expense reductions that they achieved in 2020. And so they're really not willing to sell off of pre-pandemic earnings. But how do you look at the earnings in the PPP funds? What we see most buyers do is they look at the periods where the business was affected by the quarantine or COVID, particularly March, April, and May, and they're in effect in many ways just normalizing those 3 months. So supplanting the performance of 2020 with maybe the average of the last three March, April, and Mays, and not necessarily leaving in the PPP funds, but rather adjusting for those 3 months to try and normalize for a normal March, April, May. And then, of course, post May, when you look at the second half, some are looking at some of the outsized gross profit margins and maybe reducing them a bit to a more normalized level as we've seen in prior years. However, keeping in mind that sales are likely going to rebound, so that is an offset going forward. So that is the trick of valuing dealerships in 2020. It is not a simple task. It does require a lot more analytics than simply, pulling the numbers off a statement and adding some add backs and then throwing on a multiple. It is we are seeing is buyers are really having to assess the prior year's earnings, and then, of course, look at what they think they can achieve to come up with a valuation that is fair for the buyer and fair for the seller. I don't know if I have any other questions. I don't see any. So with that, I am, let's see, I think maybe there's one more. I can figure out how to look at this.
I can read it for you, Erin.
Oh, thank you.
It says, what is your opinion of Genesis? Going upstream is difficult. Will dealers invest in facilities? Will they be the next Lexus or the next Infinity? Is this a good buy?
I think the jury is very much out on Genesis. I think that I just spoke with a dealer yesterday that called me on this exact question. And I think that the challenge is, of course, that the luxury market has lots of options for consumers. So to jockey into this segment, you're going to inherently have to take share from someone else. And the facility requirements, again, are the biggest issue because we continue to hear this drumbeat of online sales. And in fact, if you look at the Genesis model originally in Canada, I believe a lot of it was supposed to be more of a delivery point. The dealers were going to be more of a delivery point and get that kind of Volvo model of just a fixed delivery fee. As I pointed out in the presentation, and we discuss in our next Blue Sky report, so much of what is great about auto retail is our pricing flexibility. That is why we were so successful last year. And so unless you feel confident in that Genesis will retain that, will not shift suddenly to a one price model or a delivery point online sales model, I think it's hard to make those investments in a nascent franchise. So I think that the jury is very much still out on that franchise.
This is really great information. We appreciate you always taking the time to share it with us. AIADA members that are on the line, you will be receiving the Blue Sky report when we have it. So be on the lookout for that. Again, to those on the line, you should be receiving a recording of this webinar by the end of this week. Join us back here next Tuesday, March 23rd at 2 p.m. Eastern as Benjamin Tweel, Senior Cyber Crime Specialist at Bank of America, discusses cybersecurity in the auto industry. You'll also be receiving promotions on how to register for that. For more information about AIADA, visit AIADA.org. Thanks for joining us and have a great day, everyone.